While everybody's distracted by the debt ceiling crisis, there's something much more important going on. We know that these politicians are going to waste our time, they're going to waste our money, and we see it each and every day all around the world. But what's actually important, and why is it more important than the debt ceiling, which is taking front page news everywhere? I'll bring that to you today. My name is David Quintieri. I spend the hours so you don't have to. All you gotta do, subscribe. I bring you the latest and greatest. Let's get into it right now. I wanna show you what's happening with the debt deal and then give you what's actually more important. But this is something that we need to talk about really quickly. Emerging US debt deal would raise the limit and cap spending for 2 years. Defense spending will be permitted to rise yet another 3%. Debt ceiling negotiations race to cement deal before the June 5th deadline. So just before the recording of this video, that was extended out and nobody really knows exactly what date it will be. But now we're being told June 5th instead of June 1st. Debt limit talks get more time as the US Treasury pushes back the deadline. Clash over expanded work requirements remains unsolved. That's part of all of this. But we got to understand where we are at today. The economy is not as healthy as they told us it would be. This is one critical aspect. The federal government faces an unsustainable, long-term fiscal future is the blunt warning from a new report from the GAO, that's the Government Accountability Office. The $1.4 trillion federal budget deficit in fiscal 2022 was the fourth largest in US history. And guess what? That was a 50% drop from the year before. All of that, the paychecks going out and everything. You got to understand that when you're adding trillions upon trillions of dollars into an economy that cannot handle it, of course, you are going to have some issues. And that may come up, in different places you never would have expected. When we look at a lot of the data, a lot of the statistics that are coming out there, we're going to see one thing. And if we don't look at all the connected dots, we're going to be confused by it. Like right now, as I'll show you, consumer spending is up. But what is the real detail there? Because the vast majority of the mainstream media, as well as all the YouTubers, are going to tell you spending is up. And that is positive for the GDP. There's no question about that. But why is spending up? Well, many factors. One being, it's because interest rates are up, borrowing costs are up, and inflation is up. So people have to spend more money on the things they always had to, their food, their energy, their shelter. So that doesn't really look very good for the consumer, their standpoint. You and I, when I go to the store and I see the price of things and I'm thinking, wait a second here, I thought this was due to, 2020, everything's locked down. Oh yeah, things are gonna go up. What about toilet paper? Can we talk about that for a second? I thought that the prices of toilet paper were heading higher only temporarily because they didn't have enough workers, because they couldn't get enough people in the transport and all of these things. I thought that's what it was. And that, don't worry, in time, it will come back down. The price of that toilet paper has increased by what? 50% at least over the past 2-3 years? Now, is that an inflation level of, 5%, 6%, depending on what it is? Absolutely not. It doesn't represent reality. And that's why when we look at this information, we have to read between the lines. Anybody who's subscribed to the channel knows that that's exactly what I do for you. And then I bring it down and make it simple, real world terms. So what we had here is part of the problem. What we also have to look at is what's happening with the economy, jobs, and everything, and the warnings coming from both JP Morgan and Goldman Sachs. First, I want to talk to you about something really important. Check this out. So good luck if you need to borrow money anytime soon until the inflation crisis is settled. Experts from the biggest names in bonds like BlackRock, the people behind the quintessential stable investment of our parents' generation, say that we should expect a new era of volatility. In fact, according to the MOVE Index, which measures bond volatility, bond market turbulence is already at levels we haven't seen since the 2008 financial crisis. Now, by the time you see this, we'll be 4 days away from the debt ceiling deadline. And if we reach a resolution, great. But like I said earlier this week, this is just the beginning of the great financial reconfiguration. So you could take your chances with the public markets, or you could follow the smart money, which is flowing away from volatility and into exclusive lower correlation assets like fine art. Masterworks has sold over $45 million worth of art and distributed the net proceeds to their investors. In fact, each of their exits so far have delivered positive net returns. So it's easy to see why demand is still high. And with the market still lagging, there may be a wait list. But my subscribers can skip the line and get started today by clicking that link in the description. And now what we have to look at is the economy. Very important stuff. The first thing is about spending. US consumer spending jumped in April and inflation accelerated. Two things. So that is the Wall Street Journal, the same out of Reuters, same information. Strong US consumer spending. Inflation readings put the Fed in a tough spot. Do you see what's happening here? The Federal Reserve is saying we are trying to push inflation down, and yet inflation is staying persistent. My toilet paper isn't getting any cheaper, okay? I don't know about you, but every time I gotta go to the store, these things are running hot, running real hot. And I'm not gonna listen to that inflation is transitory nonsense. The vast majority of people said that it's gonna be transitory. And then, oh yeah, well, maybe it's not gonna be transitory. Oh, and then interest rates, they're not gonna raise interest rates. No way, absolutely no way, no how. Almost everybody, mainstream media, as well as all the YouTubers, know they're not going to increase interest rates. Then, oh, well, they might do it just a little bit. Here we are at 5%. 5% right now. And so we got to realize what's actually happening. They cannot stop inflation when these interest rates are even at these levels. Things are taking off. This is for different reasons. Number one, you print a whole bunch of money from the Federal Reserve, you dilute the currency. The second thing is that you're going to see the government just giving out cash left, right, and center. That's going to create another issue. But at the same time, we have corporations saying, hey, our input costs have gone up. Maybe we could increase cost. Maybe we could put that price up a little bit. We were selling that product for 10 bucks. Toilet paper, let's say it was at $10. You know what? We're experiencing a problem, lockdowns and shortage of workers and social distancing. Let's charge $12, and then we'll tell everybody we're going to bring the price back down later. And then it's $13, then it's $14, then it's $15. Hey, wait a minute, are people still buying? Yeah, when they go to the bathroom, they got to use it. So let's just keep it where it is, and that's what happens. So it's many layers. People just blame one thing. They want to blame their favorite politician and so on. I'm here to tell you, give you a little wake-up call, give you a little kick in the backside. Oh, was that too tough? You got to wake up. Let's go. Bankruptcies among large companies are on the rise. This is a real economic indicator. Okay, we haven't seen this since 2010. Very important stuff to see this right now at this time. We're talking about large companies. We have this filing flurry. U.S. courts break record for busiest bankruptcy week so far this year. Okay, so all of this coming at a time in which we are seeing recession being talked about, but at the same time, others are saying, what recession? What do you mean? Well, you can see the warnings from certain individuals, one of them being Jamie Dimon, as well as David Solomon. That's JP Morgan and Goldman Sachs. They warned of serious headwinds for the US economy. And that should be something to pay attention to. Not because it's necessarily coming from these individuals. But like, you got to realize that these people, they have every reason to tell you everything's going to be okay because they have a lot of money at stake. They want to tell you everything's just fine. Don't worry. It's all good. Keep your money in. Don't sell. We got the products to give you. You're all good. But when they have to come out like this, it's because they don't want to look too foolish. This is important. So that's what we see with these warnings. And at the same time, JP Morgan, among others in the financial industry, are cutting jobs. In this case, 500 jobs this week. You see with the tech jobs, 200,000 tech jobs, as I covered in a previous video just maybe a day or two ago. One of those issues was that in October of 2022, they started to actually cut the jobs. That was kind of where it happened. At the same time, the stock market went up. Now, what do we see? What's that correlation? It's that the stock market loves when people get fired. That is fantastic. Unless the company is going to be completely obliterated, firing people does so well. Look at Facebook, Meta. They started getting rid of a lot of people. And that was when the stock started doing well, approximately. It wasn't when they were, pouring way too much money into the metaverse that nobody, it's kind of weird and stuff. That whole thing has started taking the stock down. And then they said, we're going to fire a whole bunch of people. Just every day, fire, fire, fire. And the stock started climbing. You could look at that. Any of these big companies, Facebook's going to be there tomorrow. So if they start firing people, wow, this is fantastic, right? Well, for the shareholders it is. Not for those people that don't have that paycheck anymore. Europe's economic engine is breaking down. This is Germany is at risk of a long, slow decline with consequences for the whole EU. You know what's going on. I have said this before. The position of Europe is absolutely terrible. They relied way too heavily on Russia for their energy. This is a big issue. The US is potentially positioned to, benefit from all of this because they're shipping a lot of the energy over to Europe right now. Same moment, we have the IMF saying that the US should tighten their fiscal policy to help cut persistent inflation. Can you believe that? Don't put out cash there. Don't throw cash out the window. Don't make it rain from the sky. No, you gotta tighten your belts a little bit. Can you believe this? Wow. All right. And then what I wanted to just cover here is just to show you that you need to go into my channel and go down to the very bottom. Like you go to the Money GPS, scroll down to the bottom. I got this playlist that I created called Financial Education. A lot of people say, well, what do I do with all this information? I've got 20 videos in here that really highlight what you can do as an individual, right? I think it's really important how to safeguard your wealth with these assets. I talk about that. Why you would want to have real assets. So if you're not doing this, I really think that you are missing out on a lot. I will put that link right here, how to safeguard your asset, and also check out the playlist, scroll down to the bottom, and you get that playlist right there. I'll see you there. Take care.